Markets are partying while Washington is still padlocked. As of Monday, November 10th, 2025, stock futures are jumping on a single headline. The Senate is taking its first tentative steps toward a bipartisan deal to reopen the government after a 40-day shutdown. Green candles everywhere, risk assets rallying, traders celebrating like it's New Year's Eve. But here's the twist. The government doors are still shut. Bills haven't been signed. Furloughed workers haven't clocked back in. So why are markets already pricing in the party? Today we are going to reverse engineer this rally, break down the liquidity waves that are about to hit, decode what the Fed's chaos actually means for your portfolio, and hand you a tactical playbook so you don't end up buying the top of a one-day spike. Stick around, because by the end you'll understand exactly how to surf these waves instead of getting crushed by them. Let's start with the obvious question. Why do stock futures jump before anything actually happens? It feels weird, right? The Senate is talking. No law has passed. The House still has to vote. Government workers are still locked out. Yet Sunday night into Monday, futures climbed on pure hope. To understand that, we need to zoom out to first principles. Asset prices equal expected cash flows divided by your discount rate plus a risk premium. Think of the risk premium as an uncertainty surcharge. When scary headlines dominate, investors demand extra return to hold stocks or bonds because the future feels foggy. A 40-day shutdown injects a lot of fog. Will contracts get paid? Will economic data even get released? Will this drag on for months? All that uncertainty inflates the risk premium, which mechanically lowers prices. But here's the key insight. When resolution looks imminent, that uncertainty surcharge compresses way faster than actual cash flows can recover. Imagine you've been holding your breath underwater. The moment you see the surface, your body relaxes before you even take a breath. Markets work the same way. The Senate's tentative framework signals the surface is close, so the surcharge evaporates and prices jump first. That's not irrational exuberance. That's repricing risk in real time. But if the rally is driven by uncertainty fading, we need to ask the next question. What happens when the doors actually open and fresh liquidity starts moving? Two liquidity waves are about to collide, and understanding both is the difference between a smart trade and a painful one. Wave A is the pro-risk wave. The moment the government reopens, delayed federal outlays start flowing. Back pay hits the bank accounts of hundreds of thousands of furloughed workers. Reimbursements flow to states that fronted cash for federal programs. Vendors who paused contracts get paid. This is a short, sharp cash injection into households and businesses. People who were worried about missing rent suddenly have money to spend. Contractors who delayed orders start buying again. It's like turning on a tap after a drought. Waiver feels good. It's liquid, it's immediate, and it tends to lift spending-sensitive sectors fast. But here's where it gets interesting. Wave B arrives almost simultaneously, and it's more complicated. The Treasury has been running on fumes. Its cash balance, officially called the Treasury General Account or TGA, is dangerously low. The second the government reopens, Treasury has to rebuild that war chest quickly. How? By issuing a flood of short-term debt, mostly Treasury bills and something called cash management bills, or CMBs. Think of T-bills as IOUs the government sells to raise cash fast. When Treasury floods the market with bills, it absorbs liquidity from investors and money market funds. That's cash leaving the system to go sit in the government's account. So Wave A injects liquidity, Wave B pulls it back out. They don't cancel perfectly. The timing, the size, and who gets hit matters a lot. And that collision is about to reshape the bond market in ways most people aren't watching. Now, to invest intelligently through this collision, you need to understand how the bond market will react. Bonds are the foundation of all asset prices. Their yields set the discount rate for everything else: stocks, real estate, corporate credit, you name it. Right now bond traders are facing three massive uncertainties all at once, and together they're creating what headlines are calling Fed chaos. Let's decode that phrase, because it's not randomness. It's three very specific problems interacting. Problem 1 is a data blackout. The Bureau of Labor Statistics, the Census Bureau, and other agencies that produce the economic reports the Fed relies on were shut down. Jobs numbers, inflation readings, GDP estimates, all delayed or missing. Policymakers are flying blind. Imagine trying to land a plane in fog with half your instruments offline. That's the Fed right now. Problem 2 is institutional pressure. There have been high-profile warnings and reports about attempts to interfere with the Federal Reserve's independence, including threats to remove a sitting Fed governor. Whether or not those efforts succeed, the mere possibility raises what's called term premium risk. Term premium is the extra yield investors demand to hold longer-dated bonds when the future structure of policy feels uncertain. If the Fed's independence looks shaky, that premium goes up, pushing long-term rates higher even if short-term policy doesn't change. Problem 3 is a policy pivot. The Fed just announced that quantitative tightening, or QT, ends December 1st. QT is when the Fed lets bonds roll off its balance sheet without reinvesting the proceeds, effectively pulling liquidity out of markets. Ending QT means the Fed will start reinvesting again, but the twist is they're directing those reinvestments toward Treasury bills, not longer bonds. That changes the supply and absorption mix at the front end of the curve. So you've got missing data, institutional risk, and a shift in Fed operations all happening at once. That's not chaos. That's a very specific cocktail, and bond curves are about to translate it into prices. Let's map the roadmap for bonds, because this is where the waves and the Fed's fog collide into something tradable. In the near term, expect what traders call a bear steepening. That's a fancy term for a simple idea. Long-term rates go up more than short-term rates, and the yield curve gets steeper. Why? 2 forces. First, Treasury is about to dump a wave of bills and longer bonds into the market to rebuild the TGA. More supply means investors demand higher yields to absorb it all. That hits the long end harder because term premium reprices. Second, the institutional and data fog we just talked about makes the far future feel riskier, so term premium climbs. Meanwhile, the front end of the curve, the very short maturities, stays more anchored because the Fed's actual policy rate moves slowly and the end of QT provides some support through reinvestments. So you get long rates rising, short rates steady or up a bit, curve steepens. That's wave B asserting itself. But medium term, if the delayed economic data finally gets released and it confirms growth is cooling or inflation is moderating, duration bids return. Duration is bond speak for interest rate sensitivity. If the economy looks softer, investors rush back into longer bonds betting the Fed will cut rates down the road, and the curve can reflatten or even invert again. The sweet spot to capture that dynamic without taking maximum term premium risk is the 3 to 7 year part of the curve, sometimes called the belly. It's long enough to benefit if the Fed eases, but short enough that you're not fully exposed to term premium shocks from supply or political noise. That's your bond market roadmap. Relief and supply create a bear steeper now. Data clarity and easing bets can flatten it later. And that sequence has huge implications for which stocks and sectors outperform. Equity rotation math is where this bond view turns into real money. History shows relief rallies after shutdowns or similar uncertainty events tend to favor a specific cluster of stocks. Domestically leveraged cyclicals and small caps do well because they benefit from lower front-end rates, which reduce borrowing costs, plus reopen government procurement and backpay spending hitting Main Street fast. Defense and aerospace stocks get clarity on appropriations and contracts, removing a major overhang. Travel and airlines see staffing at TSA checkpoints and air traffic control normalize, reducing operational bottlenecks. These are the names that pop in Wave A. They're sensitive to near-term liquidity and confidence, and they've been beaten down by uncertainty, so the snapback is sharp. But here's the trap. Wave B, that bill supply and term premium backup we talked about, can later pinch high duration, far future cash flow stocks. Think unprofitable growth names or very long duration tech that trades on dreams 5 or 10 years out. When long rates rise because of supply or term premium, those stocks' present values compress. It's the flip side of the bond steepening. So a barbell strategy makes sense. Own quality cyclicals and small caps for the relief pop. Keep a core position in profitable, cash-generative technology companies that aren't levered to distant promises. And underweight or avoid unprofitable, long-duration growth until the supply wave settles and the curve picture stabilizes. This isn't about abandoning tech or growth forever. It's about timing which flavor of equity wins in each phase of the liquidity cycle. And with that rotation map in hand, we can finally build a concrete playbook so you don't buy the top of a one-day future spike. Here's what to do now, step by step, with real instruments and real timing. First, do not chase the first day candle. Futures jumped Sunday night on hope, but the Senate framework is tentative. The House still has to vote. Language can change. Headline risk is alive. Scale into positions over 3 to 10 trading days as the legislative path gets clearer and the final bill language is priced. Patience here is free insurance against a headline reversal. Second, add 3 to 7 year duration in treasuries or investment-grade corporate bonds. You're buying into the medium-term easing path while limiting your exposure to the term premium shocks that hit the 30-year. This is where the bond roadmap pays off. Third, tilt your equity exposure toward US cyclicals, small caps, defense, and travel for the relief wave. Keep your core in profitable, cash-rich tech names that generate earnings today, not in 2030. And underweight or trim unprofitable, long-duration growth until the bill supply wave passes and the curve stabilizes. Fourth, use liquid Treasury bills as dry powder. Treasury is about to ramp bill issuance to rebuild cash. Bills will offer attractive short-term yields with minimal duration risk. Park cash there and roll them as conditions evolve. You stay liquid and you earn while you wait. Fifth, hedge near-term deal risk with 30 to 60-day put spreads or collars on the major index. If the House vote stumbles or new political noise erupts, you're protected on the downside without giving up all your upside. These 5 steps together give you asymmetry. You capture the relief rally, you're positioned for the bond dynamics we mapped, and you're hedged against the headline risk that's still very real. This isn't a bet. It's a disciplined, high-odds plan built on liquidity waves and curve mechanics. So let's tie it all together with the bigger lesson, because this shutdown reopening dance is a microcosm of how modern markets actually work. The shutdown was the fog. Uncertainty everywhere, data missing, cash flows frozen, risk premium spiking. The reopening is sunshine breaking through, but the roads are still wet. You'll see farther, yes, but traction isn't perfect. There are 3 waves, and each one has different physics. Wave 1 is the relief pop. Uncertainty compresses, risk premiums fall, prices jump before fundamentals even recover. That's where we are right now. Wave 2 is the bill supply undertow. Treasury rebuilds cash, liquidity gets absorbed, term premium reprices, and the curve bear steepens. That's coming in days and weeks. Wave 3 is the Fed navigating without instruments. Data trickles back in, institutional pressures simmer, and the policy path recalibrates in real time. That unfolds over months. Your job as an investor is to ride the first wave with positions that benefit from confidence returning. Respect the second wave by managing duration intelligently and avoiding the sectors that get hit hardest by rising long rates. And prepare for the third wave by staying liquid, staying hedged, and keeping your strategy flexible as the data fog clears and the Fed's reaction function comes back into focus. Markets don't move in straight lines, and headlines are not strategies. What separates winning investors from the crowd is understanding the sequence, the liquidity, and the mechanics beneath the noise. Today you got that map. You know why futures jumped before the doors opened. You know the 2 liquidity waves and how they collide. You know the bond curve's expected path and which equities benefit in each phase. And you have a 5-point playbook to act on it without getting whipsawed. That's how you turn a headline spike into disciplined, repeatable edge. If this breakdown helped you see through the noise and build a real plan, hit that subscribe button so you never miss the next one. Drop a comment and tell me which wave you're positioning for or what sector you think gets overlooked in the reopening trade. And if you found this useful, share it with someone who's trying to make sense of what comes next. Markets reward preparation, not hope. You just got prepared. Now go use it.